Number 5, at the beginning of the current year, Taunton Company's total assets were $255,000 and its total liabilities were $178,500. During the year, the company reported total revenues of $100,000, total expenses of $79,500, and owner's withdrawals of $5,700. There were no other changes in the owner's capital during the year, and total assets at the end of the year were $267,000. Taunton's company's debt ratio at the end of the current year is what? Well, debt ratio is what we're looking for, and we're looking for it at the end of the year. So debt ratio is total liabilities divided by total assets. So let's start with what we know. At the beginning of the year, we know that the assets were $255,000 according to this information, and liabilities were $178,500. And if we know these two pieces, assets and liabilities, we can compute owner's equity at the beginning of the year, which was $76,500. That's computed there. Also, during the year, we know that revenues were $100,000, and that increases owner's equity. We know that total expenses were $79,500, and that decreases owner's equity. And we know that the owner's withdrawals were $5,700, and that also decreases owner's equity. So when we combine all these things, we can now find what the ending owner's equity is, which in this case would be $91,300. But we're looking for the debt ratio, and we're looking for it at the end of this year, or at the end of this accounting period. Well, let's see. We know that total assets at the end of the year were $267. So that's one piece of this debt ratio. To find the liabilities, if you already know the owner's equity and you know the assets, then you know that the difference between the two will be liabilities, which would be $175,700. So you have enough information now to find out what the debt ratio was at the end of the accounting period, which would be total liabilities of $175,700 divided by total assets of $267. This gives us a debt ratio of 65.8%.